Thank you, Simon, and thanks everybody that are here in the room and that are listening online for listening to this talk and for giving me this opportunity to talk a little bit about this report that I've written and these very important issues. So we've titled this New Times, New Taxes, Sweden Add Minimum Corporate Taxation in the EU. What can be a more glamorous start of the day? So what's this about? So I'm going to try to explore and explain these very complex issues surrounding profit shifting by multinational firms and the EU, how they try to limit this and regulate this. I will definitely focus on the Swedish context, but it's a more broader picture. We're going to zoom in on Sweden here. And I'm an economist, so I'm going to focus on the economics, not on the technical details. It is very complicated. I don't understand everything. There are very few people out there that actually does. In my day job, I'm a labor economist focusing on firm dynamics at the Research Institute of Industrial Economics, but I like to venture into the realm of public taxation. And you have very different starting grounds. Some of you might have participated in the negotiations. Some of you might have never heard of a QDMTT before, but hopefully afterwards we can be a little bit more on the same page. And hopefully this presentation and this report is the starting ground for a broader public debate about these issues. So let's start with these two graphs to set the stage on where we're coming from. So think about what are the big changes in the economy and how firms operate the recent decades. So there are two big trends here. So the first one shows how much Swedish firms are spending on ICT, so software computers, and from early 2000 to today. And you see the red line on top, it going up. So ICT is more and more important. New technologies enable firms to do new things and have completely new business models. And in particular, it allows you to separate production from your customers. If you imagine a factory, you have your factory and it's very costly to ship your stuff somewhere else. But if you're online, you can have your headquarters somewhere and then have your customers anywhere in the world. Together, there's another trend, which is globalization. There are different ways to visualize this. And here I'm just showing what share of Swedish workers in the private workforce work for a foreign-owned company since the 1980s. And you see there's a large increase here as well. So we have more cross-border ownership, meaning that issues relating to how do we regulate this and taxation between borders become more and more acute and important to discuss. All right, so taking a step back, okay, how should we think about corporate taxes here? So in the ideal case, profits should be taxed at most once and ideally at least once. Neither of these are trivial. This means you need to have complicated rules how to allocate profit between different countries. If you have a headquarter in one country and a subsidiary someplace else, both countries could claim to tax these profits. And we don't want that to happen. But we also don't want profits to not be taxed anywhere, at least not without the government saying that these should be taxed at 0%. We don't want different financial setups to mean that profits aren't taxed anywhere. And the thing is that multinational firms, and we want them to distribute profits between subsidiaries in some way. And that's the fundamental principle is that you should treat them as if they were independent firms. But then, of course, they aren't independent firms. So they need to come up with some way to price and imagine what would be this imaginary price. So this is called transfer pricing. And think what would be the market price of using the license of a big tech company in a given country. So then, let's say Google has a subsidiary in Sweden. What would be the market price for a Google subsidiary in Sweden that it should send back to headquarters? And this is definitely not trivial. And this also gives rise to opportunities for firms to use this to their advantage. And in practice, there's a lot of research showing that they can use complicated systems of how you allocate immaterial assets and various financial instruments to move profits to low-tax countries. And how important is this? That would be a legitimate first question. Maybe this is just a very small thing that we don't need to worry that much about. And this is very difficult to estimate. And in general, all these figures should be interpreted very cautiously. It's difficult to estimate because we don't have very detailed data. So we have to, rely on different estimates and try to have a sense of the magnitude. So current research suggests that at least this so-called profit shifting is large, and is very large. It's in the order of magnitudes of hundreds of billions of dollars annually. Still large variation from $400 billion up to $1,000 billion. And I don't think we need to stare blindly at the exact figure, but thinking, okay, there are lots of money that are shifted from high-tax countries to low-tax countries. And this, of course, introduces tensions in the global political economy. And now let's try to zoom in on Sweden. That's also difficult, of course, but there are estimates. And here is one estimate that try that. So for Sweden, you should think about roughly $12-13 billion that are shifted to low-tax countries. But note that most of it going to other EU countries, Ireland, Luxembourg, Netherlands, also Belgium. This is going to be important later. So when you think about how Swedish multinationals behave, you should think about moving profits around in Europe, not sending them, let's say, to Cayman Islands or the Bahamas. But there's profit shifting in Sweden as well, or out of Sweden. Okay, so if changes in the global economy mean that firms can, to a larger extent than before, move profits to low-tax places, then there's a clear incentive for governments to lower corporate tax rates. And on the left-hand side, you see statutory corporate tax rates, and we see that by and large they seem to be declining since the 2000s. You can go further back and see a similar trend. Also interestingly, you can see that the revenues from the corporate income tax here as a percentage of GDP is much more stable. Surely it's fluctuating year to year, but there's no significant downward trend. So this is an interesting puzzle in the literature and for policymakers. There are different explanations. One is that it has been more easier to change incomes from labor income to corporate income. Another one is that you have changed the tax base for corporate income, meaning that even if the tax rate is lower, more profits are included as corporate income. And finally, there's also a rise of the financial sector that also means that corporate income taxes have been increasing secularly anyway. But this is definitely this is an interesting puzzle, but for sure there is a tension here that global policymakers are worried about. All right, so we have that changes in the global economy means that countries are not, they have to fight over who gets to tax what profits. To some extent, this seems to drive corporate tax rates down. Global policymakers are worried what's going to happen in the future. And that means that, okay, let's try to coordinate this in some way. And there's been a long political process over many years trying to figure out new frameworks for how to deal with this. And this has been spearheaded by the OECD and the G20 under the Base Erosion Profit Shifting, or BEPS program. So this whole literature and people here really love coming up with new terms and lots of abbreviations. I'm going to try to limit them, but some of them I think are useful to know if you do further studies here. So they initiated this large way to reform the global system. And originally there were two big ideas called Pillar 1 and Pillar 2. And Pillar 1 was about changing the rules of which countries can tax a given profit. So let's say Facebook has customers in Sweden. That means in some way that some value is created in Sweden, but Facebook has also headquarters someplace else. Imagine they were in Belgium. Should Sweden or Belgium get to tax these profits? That's really what Pillar 1 is about. Pillar 1 is, as far as I know, basically not moving along anymore. But thankfully, there's another pillar, so I have something to talk about. And this is the Pillar 2, which is basically a floor on the corporate income tax, or a minimum corporate income tax. And there's been a lot of action recently. And most noticeably, there's a new EU directive that implements this. This has also been implemented in other countries, or about to be implemented, Colombia, Japan, South Korea. So there's a lot of action going on here. So it's important. So this is already happening in the world, and it's important to understand what's going on here, what are the likely effects. So I'm going to focus a bit on the EU minimum corporate tax, which is based on the rules provided by the OECD, which are not completely done, which means there's a lot of uncertainty exactly how is this going to look like from the OECD, how is this going to be interpreted, and then how is this going to be implemented in the different EU countries. But I think it's fair to say that we can safely summarize the basic details of how the basic idea of how this works. So the core idea is quite simple, is that all large firms should pay at least 15% in taxes, so 50% of their profits, in countries where they have substantial economic activity. And there are details exactly how these things are defined that I don't think are important right now. And there are basically different ways this can be done, and there's an priority order. And the most important one is the qualified domestic minimum top-up tax, QDMTT. So now you learn what QDMTT is. So what is that? So it says that a country can determine that. So let's say Sweden can determine that Sweden should levy if there is a firm active in Sweden that qualifies to these rules, and they don't pay 15%, then the Swedish government can say, we're going to take a top-up tax, so they pay 15%. And now, if there is a country that does not introduce this, let's say there's a Swedish firm that has active in, let's say, the Netherlands, and the Netherlands would not introduce this rule, then the Swedish government will then instead have to use the income inclusion rule, or IIR, which means that the Swedish government should then take the remainder of, let's say the firm pays 10%, then Sweden should take 5 percentage points more in taxes and take home to Sweden. I'm going to have a picture soon to show how this works. So either it's taxed in the host country or it's going to be taxed in the source country. And if the host country decides to have this QDMTT rule, it's going to take precedence over this rule. There are definitely a lot of details around here. So for instance, the policymakers recognize that a lot of business is not simply profit shifting, so their firms are allowed to deduct a fraction of the material assets and payroll expenses before you calculate the tax rate, substance carve out. There are also additional provisions here, such as safe harbor rules, which could exempt firms that plausibly would not meet the standards to fall under these rules, and then it would not have to do all this costly reporting to the tax authorities. So here's a little picture that tried to visualize how it works. So here is a firm it's a subsidiary firm in country A, and it has a parent company in country B. And then you ask, after all these deductions and stuff, is the tax rate above or below 15%? If it's above 50%, then it's good. If it's below 15%, then you would ask, does this country has a qualified domestic minimum top-up tax? Yes or no. If it has one, then the country will levy a top-up tax to 15%. And if it doesn't, then the country of the parent, let's imagine it's called country B, will instead levy this top-up tax. So the firm will have to pay to the country of the mother or parent company. So we're going to see two interesting things here. First, there's going to be this tension, right? Which country is going to tax which firms, which in a way reminds us of Pillar 1, which already had this dimension. And two, no matter where you end up, the money ends up, the firm is going to have to pay 15% taxes anyway. So it's going to increase the tax burden of the firm. Okay, so that's the minimum tax very much in brief. There's much more details, but I think this is really the essence you need to know for this talk. If you're interested, you can go either to the OECD model rules, the EU directive itself, or for the Swedes, there is this Swedish government reports how to implement this in Sweden. They're all very interesting, but they're also all very long and very complicated. So coming back to economics. Okay, so how should we think a little bit more principally about harmonizing taxes in the EU? And the first thing is that, as we learned, corporate taxes are mobile. And taxes in one country affect the incentives of politicians in some other country. And yes, this does also give incentives to have a good business environment to attract foreign investments. We also risk these excessive tax cuts, the race to the bottom that I showed before. So then harmonizing within EU might be a good thing. Well, harmonizing with the EU risks that firms move out of the EU someplace else. depending, of course, on how important do we think the EU is as a market. And probably for in many cases, firms are going to stay in the EU and pay these taxes, but that risk still exists there. And it's also good to remember that there are other ways you can coordinate. You can have information exchange, which is already happening, both corporate and personal wealth and income taxes. So you don't need to, the home country can still know of the activities of the firm. You can also introduce a common way of calculating the tax base, meaning it will be more difficult to use differences in rules to simply use these differences in rules to reduce your tax burden. And of course, some kind of minimum corporate tax. And lots of references again. I think the key takeaway is simply that there have been initiatives earlier to curb profit shifting, and by and large, they seem to be at least moderately successful. The US has done some initiatives earlier to make it more difficult for firms to profit shift, and that seems to have reduced profit shifting. Different disclosure rules in Europe has also made firms more willing to take back income. Of course, at some way, if we increase corporate taxes, we might, have less investment on the global scale. And the OECD and EMF has calculated some of that as well. So there's definitely, a downside to this. So then one of the big questions is, will this reduce tax competition? That's the purpose of these policy proposals to begin with. And to some extent, it would. I think we can expect that tax differentials between high tax and low tax countries will decrease. And this should benefit Sweden because Sweden is a high tax country. But of course, as I mentioned, there are risks that firms move outside the EU. And at the same time, even under this system, there are ways for low tax countries to offer various forms of tax rebates or similar schemes to firms if they want to attract foreign direct investment or firms to move there. So it's not this is not like a waterproof way to end all tax competition. But I think it's fair to say that this is definitely going to reduce the tensions in the current system. I think it's also worth mentioning that, all these new reports that we have to submit to tax authorities, they're going to, introduce administrative costs for firms, lawyers, accountants, consultants, IT systems. And for the Swedish government report estimates costs of up to 1 billion SEK annually. Also, if there are high administrative fees and vague rules, this also introduces uncertainty for firms. Do they risk having these penalty fees just because they misrepresented some report from, let's say, South Korea? So these are concerns we have to think about, and ideally you want reporting costs to be low. Ideally, if we reduce the incentives for tax competition, maybe firms can also spend less on tax lawyers, and so maybe the net costs are not as high. But we'll have to see. But there are definitely downsides to this. So then, tax revenue effects. Will there be more money in the government's coffers? The short answer is who knows. But of course, there are people that try to estimate this. OECD, you have done like global estimates, there are also EU estimates, a little bit for Sweden. This is difficult to predict at many reasons. There's insufficient data. We don't really know the details of the rules. We also don't know how countries exactly what they will implement. We also don't know exactly how firms will behave. So, this needs to be taken with a grain of salt. But on the global scale, estimates suggest that Pillar 2 can raise corporate income taxes by 5 to 10%. And it's if you think they're erring too low or too high, that's up to you. But that's what I think the best estimates are today. Also being for the EU, roughly 50 billion euros. So even if you think this is erring on the high side, there's still a lot of money involved for governments here. And given how much time has been devoted by all these global institutions, I think it's fair to say that at least some people believe there's a lot of money involved here. Now, what about Sweden then? So remember that Swedish firms mostly profit shift within the EU, and other EU countries are likely going to introduce this top QD MTT rule, because otherwise they would be leaving money on the table. So that mean there's not that much money left for the Swedish government. So if all money that was profit shifted would be able for the Swedish government, we would end up abstracting away if firms would change their investment behavior as a consequence of this. you would end up with like the blue bar would be roughly on the order of, let's say, 2 billion euros, dollars here. And now there are these estimates, okay, but that's not available because of this QDMTT rule. And then you have one report that suggests it's still around 15 billion euros. The Swedish government report is much more pessimistic. It's the green bar down here. It's roughly, let's say, 50 million euros or 500 million crowns. And I guess the truth is somewhere in between here, but exactly where it is very difficult to know. But I don't think that, as I said before, there's very much uncertainty. We shouldn't stare blindly at these numbers. And I don't think that's the most interesting takeaway anyway from here is that, okay, it's not maybe about, money in the coffers today. So, yeah, I basically said this. One thing to take in mind is that, given, as I mentioned, that they have this rule priority, so under the initial draft of the rules, where this QDMTT was missing, which means that the Swedish government would probably have been able to gain much more money, because that means Swedish firms profit shifting abroad would be taxed in Sweden. Now they're going to be taxed someplace else, Netherlands, Luxembourg, Ireland, which means the Swedish government loses out on this change in the policy system. All right, so some concluding thoughts. So thank you for listening, and I hope you've learned a little bit about this. So what are the key points I want you to take with you? So changes in technology and institutions have spurred how multinationals operate. And current estimates suggest they profit shift hundreds of billions of dollars to low-tax countries. And governments have responded, lowering corporate tax rates. Now there's a project to instead coordinate corporate taxes. And European policymakers have now introduced this new directive with a minimum corporate tax. And there are similar ideas in other countries as well. We will see how well it will work to reduce tax competition and exactly which actors will gain and lose. Let's say that the Swedish coffers won't probably increase that much in the coming years. But I think that the big point is, okay, now there's introducing new rules that are changing the rules of the game. And I think that's where the interesting part is. So we have to keep monitoring development and see what's going on. And now it's time for the broader public debate about how do we want these rules to look like? Do we want to change anything? Do we think that is 50% too much or too low? Or do we need to make it simpler for people to understand? So thank you very much for listening.
And thank you, Emil. Now they have some sound issues. But as I said, I think you've done a great job to make this complex issue very much more comprehensible. But I will take the liberty of asking the first question. That is, why is it really this complex? And does it have to be this complex? Which puzzles me.
Yeah, no, it is very complex. And as you might imagine, it's much more complex than what I made it look like. And I think there are two ways. I mean, it has to be complex because reality is very complex. And how do you even think about huge firms? They have businesses everywhere. So it has to be complex. But I don't think it has to be this complex. I mean, it's also a political process that has been negotiated for many years by hundreds of countries. So without having inside knowledge, political processes usually tend to make things more complicated because no one wants to be a loser. So I think there should probably be a way to make it easier, but that's maybe not politically feasible.
Because I think you said somewhere that when it was started this work, it was more easy, but then as the negotiation goes on, it becomes more and more complex. Is that so?
Yeah, that's my reading. At least when you look at the earlier documents, it looks like the system was much cleaner. And then when you read the later documents, there are more and more additions and more details coming along. Maybe that was planned from the beginning, but it seems that the rules get more and more complicated as time goes along. And maybe someone in the room knows why. But
and then you also showed us the revenue estimates, and the Swedish investigation shows this tiny little green bar in 15 million euros. If it is this low, why should we even do it?
No, but I think that, as I said, I think the most important thing here, even from a Swedish perspective, is not the revenue estimate, but is that Sweden as country probably has to gain from there being some form of framework that limits excessive tax competition. Because if low tax countries need to increase their taxes, then Sweden is going to become more competitive or more attractive country to invest in. So there are definitely gains from Sweden that are probably not captured here.
Mm-hmm. And then you often hear in the Swedish debate that we should not hand over competence of a taxation to the European Union. That is a dangerous path to go. What do you say to that? Do we not give any competence on taxation to the EU today?
I mean, at some sense, that's a judgment issue how much competence you want to give to the EU, but it's good to remember that this is not the first time EU has regulated tax issues. We have been harmonizing VAT, so MOMS, for a very long time. And they have this, how you should treat dividends between subsidiaries and corporate groups in EU has been regulated. There are already measures against tax avoidance in the EU. So while this is a big step, it's more the continuation of something that has been going on for a long time.
So when we hear Pandora's box will be opened, it's already open? Is that what you're saying?
Yes, Pandora's box is already open.
Okay. So there's also a little bit of worry here in Sweden that some say this is a backdoor to Pillar 1. How do you see that? I mean, we want the floor, but Pillar 1 is more controversial in the Swedish debate. What's your view on that?
Yeah, exactly. So Pillar 2 was the floor, and Pillar 1 was about which country is going to be able to tax which profits. And I mean, it's difficult to predict the future, right? But I think the important difference here is that Pillar 2 there are many countries that would benefit from Pillar 2. So this should be a larger coalition behind this, whereas Pillar 1 is much more controversial because it's more about redistribution within the EU. So sure, the framework is in place, so maybe things are going to move along, but at the same time, there's a very different coalition behind these. So I don't think we need to be that worried. But maybe I'm too optimistic here.
And you also show the graph of the decline in corporate taxation rates. Would this put an end to it? And is it enough, or do we need to do more to stop this race to the bottom?
Yeah, no, it's a good question. I mean, even with this, so first we have to think, how much will these rules be introduced globally? Like, what kind of rules will the US introduce? So now first step is EU and some other countries. That there are still going to be ways in this for countries to offer good, indirectly reduce taxes. So just looking at the statutory corporate tax rates, it's not going to be enough. So if you want to stop the race to the bottom, you have to do more.
Okay. I think maybe that will be your final words. And thank you very much for an excellent presentation.
Great, and thank you everybody for listening.